Greg buys a 30-year term life insurance policy and invests the difference. Lucas buys a whole life policy his financial advisor said is an investment. They both think they made the smarter move. They're both wrong. Because one of them forgot that insurance and investments are different products, and the other forgot that commission salespeople aren't your financial friends. And when you actually run the numbers over 30 years, the gap is over $500,000. Let's keep this fair. Greg and Lucas are both 30 years old, both married, both have young kids. Both want $500,000 in life insurance coverage to protect their families. They earn the same salary, $80,000. The only difference is the type of policy they choose. Greg walks into a quote site and buys a 30-year level term policy. Cost, $40 a month, locked in. If he dies anytime in the next 30 years, his family gets $500,000 tax-free. If he doesn't die, which is what statistically happens, the policy expires at age 60, and he gets nothing back. He doesn't care. He didn't buy insurance as an investment. Lucas sits in his cousin's friend's office, who happens to be a wealth advisor. The advisor explains that whole life insurance is different. It's permanent protection with a cash value that grows tax-deferred. Lucas signs up for a whole life policy with $500,000 coverage. Cost, $400 a month for the rest of his life. The advisor mentions that the policy builds wealth and Lucas can borrow against the cash value later. Lucas feels sophisticated. He's not just buying insurance, he's investing. On day one, Greg is paying $40 a month. Lucas is paying $400. That's a $360 monthly difference. The question is what each of them does with the gap. Greg takes that $360 and sets up an automatic monthly deposit into a low-cost S&P 500 index fund. Doesn't think about it. Just keeps the auto transfer running. Lucas doesn't have $360 to invest. It's going to the insurance company. But he tells himself it's fine because the policy has cash value that will grow. The salesman showed him a projection that looks promising. Let's run the math through year 10. Greg has paid $4,800 in term premiums and invested $43,200 in his index fund. At 10% average annual return, his investment is worth approximately $66,000. He also still has the full $500,000 coverage for the next 20 years. Lucas has paid $48,000 in whole life premiums. He calls his advisor and asks what his cash value is. The answer? Approximately $18,000. Over $48,000 paid in, $18,000 in cash value. The other $30,000 went to insurance costs and commissions. The first 3 years' premiums almost entirely covered the salesman's commission, which can be 50 to 110% of the first year's premium in the industry. At year 10, Greg is sitting on $66,000 in liquid investments plus $500,000 of remaining coverage. Lucas has $18,000 of cash value he can't easily access without surrendering the policy or borrowing against it at interest. The flip happened years ago. Lucas just doesn't know it yet because the salesman keeps showing him a 30-year projection that looks good in isolation. Here's what the whole life salesman doesn't tell you. The internal cost of insurance inside a whole life policy is significantly higher than equivalent term coverage. You're paying for the death benefit, the cash value structure, and the salesperson's commission. The cost per thousand of pure insurance inside whole life is typically 3 to 5 times what equivalent term costs. The cash value isn't your money in a normal sense. If you want to access it, you have 3 options. 1. Surrender the policy entirely, lose the death benefit, and pay surrender charges if you're in the first 10 to 15 years. 2. Take a loan against your cash value, yes, a loan, where you pay interest to the insurance company on your own money. 3. Keep it locked in for life and never actually use it. The tax-deferred growth is real but misleading. Yes, the cash value grows without immediate tax. So does a Roth IRA. So does a 401k. So does SA. Any tax-advantaged retirement account does the same thing, except those accounts don't have insurance overhead costs eating into your returns. The illustrated rates of return assume the insurance company performs well. Whole life illustrations typically show 6 to 8% annual growth on cash value. The actual long-term realized returns on whole life policies, measured by the internal rate of return on premiums paid, average 1.5% to 3% over a 30-year holding period, not 6 to 8. By year 20, Greg has paid $9,600 in term premiums. His investment account, contributions of $86,400 plus compounding at 10%, is worth approximately $271,000. He still has $500,000 of coverage, and his kids are now adults. He could cancel the policy if he wanted, though he won't for another decade. Lucas at year 20 has paid $96,000 in whole life premiums. His cash value is approximately $98,000. The salesman shows him this favorably. You've gotten more cash value than you paid in. But the implied rate of return is roughly 0.1% per year over 20 years. He could have put that money under his mattress and done almost the same. Year 30. Greg has paid $14,400 in term premiums over the full term. His investment account, $129,600 in contributions plus 30 years of compounding at 10%, is worth approximately $748,000. The term policy expires now. He no longer has coverage. But his investment account is large enough to self-insure if he dies. His family receives $748,000 from the investment account. Plus, he can spend it during retirement. He won, and won big. Lucas at year 30 has paid $144,000 in whole life premiums. His cash value is approximately $245,000. He still has the $500,000 death benefit, but he's been paying $400 a month for 30 years to get a cash value that's worth less than half of Greg's investment account. The EAR on his policy is approximately 1.8%. If we factor in Greg's term coverage expiring while Lucas keeps his $500,000 death benefit and we calculate which family is better, protected Greg's $748,000 investment plus the certainty of self-insurance still beats Lucas's $500,000. Death benefit plus $245,000 cash value. Greg's family inherits the full $748,000. Lucas's family inherits $500,000 if he dies, and here's the catch most people miss. With most whole life policies, when the insured dies, the family receives only the death benefit, not both. The cash value goes back to the insurance company. If I only showed you the downsides of whole life, I'd be doing what every term and invest YouTuber does. Whole life has narrow but real use cases. Estate planning at high net worth is real. If you have more than $13 million in assets, the 2026 federal estate tax exemption whole life can fund estate tax payments efficiently. This applies to roughly 0.1% of Americans. Children with permanent special needs is real. If you have a dependent who will need financial support for life, whole life provides guaranteed coverage that doesn't expire. The math works for that very specific situation. Forced savings for the financially undisciplined is real. If you're absolutely certain you would never invest the difference yourself, and you've actually tested this assumption, whole life forces you to save through premiums. The math is worse, but the behavior is contained. Tax shelter at extreme income is real. If you're a high earner who has maxed every traditional retirement vehicle and still has surplus to invest, whole life becomes a marginally useful additional tax-deferred container. Estate planners use this for clients earning over $1 million annually. Whole life is the smarter move only in those specific situations. For 95% of people considering it, term life plus investing the difference is mathematically and behaviorally superior. Term life is the smarter move if you have a clear timeline of need, typically 20 to 30 years, until your kids are independent and your mortgage is paid off. If you're disciplined enough to actually invest the difference, automatically and consistently. If you treat insurance and investing as two separate products with two separate purposes. And if you understand that the goal of life insurance is to become self-insured, your investments grow large enough that you don't need a policy anymore. Over 30 years, the real trap isn't term or whole life. The real trap is letting someone with a commission convince you that insurance and investing belong in the same product. They don't. Greg understood that. Lucas didn't. because the person explaining it to him made money by not explaining it. And if you're wondering what happens with the variations universal life, indexed universal life, variable life, they're all whole life with different marketing. The math gets even worse with most of them. That's a completely different conversation. For now, the next time someone tells you whole life is an investment, ask them one question. What's the internal rate of return over 30 years on this specific policy? Because the answer that includes the year is the only answer that matters. Watch them squirm. Most salespeople genuinely don't know the number, and the ones who do don't want to tell you.